We won't see this again. We will not see a bubble economy for our kids will probably not even see a bubble economy decades and decades from now. It happens once in a lifetime at most.
And this is the bubble of our lifetime right now.
This is the bubble of our lifetime and bigger than either the 1837 peak or the 29 peak. This is going to be the biggest crisis in the baby boomers' life. The biggest crisis of the Bob Hope generation was the Great Depression. This is going to be the big crisis. The final kind of depression into this is going to hit the baby boomers the hardest because they're going to need that net worth that's going to disappear at the speed of light. And I mean disappear, not come back.
Our next guest is calling for possibly the largest crash in our lifetime in the markets. Why is this happening? Where are we in the multi-wave cycle? Harry Dent has the answers. He is the founder of HS Dent and the author of several best-selling books, including 0 Hour, Turn the Greatest Political and Financial Upheaval in Modern History to Your Advantage, and The Demographic Cliff, How to Survive and Prosper During the Great Deflation Ahead. Harry, wonderful titles you've written, wonderful books. Everyone should check out your site, HS Dent, or harrydent.com rather, and your newsletter. Welcome to my show.
Nice to be back, David.
You're calling for possibly the greatest crash in our lifetime. We already had a pretty big downturn last year. The S&P 500 was down 18% year on year, but that's not it. That's not the crash you're talking about?
Right, and in the 2008-9 crash was 57% on the S&P 500. So yes, no, this is basically what that crash should have been. People didn't notice. It's pretty obvious. About a year and a half into that crash, the central banks just stepped in and just started printing money, unprecedented rates to blow us out of that. That's what basically happened. So that recession didn't really do its job of flushing out the greatest debt bubble in history, which I've been warning about for years and decades, bigger than the Roaring '20s, which ended up in a bubble in the stock markets, and the crash of a lifetime back then, now down 89%. For the Dow, which was the leading index back then. I'm predicting as much as 86% for the S&P 500 in this crash and 92% on the NASDAQ. So in that realm of something you only literally see once in a lifetime, if that. So this is nothing. This is what my point is. Most financial advisors are right most of the time. You can just sit through most corrections and rebalance and that sort of stuff because it's not easy to time the market, as most people know. Okay, but this is so important that I am timing the market. I warned about this in my newsletter, off the charts. 2 huge warnings in mid and late December saying this crash is about to happen. It is going to be the crash of your lifetime. And next thing you know, we were down 38% in the NASDAQ in October of last year. And that's just the first wave down. There's 2 more to follow. And I think we're just about to see, or we've already started the next wave down, which could take the NASDAQ down to 8,000 just in this next wave, not the end of it. And that's going to be down a little over 50%. And that's when people are going to know this is not a big correction. It is a major crash, one that you have not seen in 73, 74, or 80, 82 in your lifetime, and one that even the millennials will not see a bigger crash than this when their boom and bust hits many decades from now.
I remember the first time I talked to you was late 2020, and you had predicted that we would begin this crash. I think it was first or second wave, and eventually it did come. You were correct in that 2022, last year, saw the stock markets and cryptocurrencies all crash, not to the extent of 50%, but actually 2022 was the most severe crash for stocks and bonds collectively if you put them together as a percentage of GDP. So in that regard, you were correct. However, it did happen later than you initially anticipated. Why did it happen later, you think?
That's extremely simple. Never before. Look at the Great Depression. Look at any major downturn. The mid-'70s. Never before have central banks declared war, literal war on recessions, and said, we will not let the economy fall. Mario Draghi was the first one to say, he said to traders who were shorting the European markets back there in 2020, when we should have had the real crash started, okay? He said, I will print unlimited amounts of money. Do not bet against me, you damn traders. And that's what they've done. They have pushed this off. But even with all this unprecedented $9 trillion for the Fed alone in money printing, never have we seen even a fraction of that, okay? Even with all of that, we keep falling back in a recession. We just came out of the COVID downturn, and with all this massive stimulus, $10 trillion, half of it fiscal, half of it monetary, the biggest single 2-year stimulus in all of history, topping everything before that, and we're already falling in a recession again. That's the problem. The economy underneath is really, really weak and really needs to get rid of a lot of really bad debt and zombie companies. And the central banks won't let the economy do its thing. Oh, we're free market capitalists. No, we're not. If you trusted the free markets, you'd let the free markets do what they do. And central banks have declared war on the free markets. That's the problem. And the free markets, thank God, look like they're going to win this. I've been fretting to my subscribers saying, I don't know if we'll ever have free markets again. I mean, this may never end. If the economy gets its way and we have this crash, it means the markets have taken back over. They're going to do what the economy really needs and not listen to stupid central bankers who never had sex or run a business. Find me one that meets either of those two definitions or looks like it. What are these people doing in charge in the first place? Okay, so that's what I see. The economy looks like, and that's why we're in a critical point right now. The economy is set by looking at the waves, and I've spent years and years studying what I call Elliott wave theory, brought by Robert Prechter. He's another good guy to interview, by the way. We're about to hit this third wave of the third wave, which the crash gets its most momentum. If that happens, if they can't stop this, and I don't think they're going to be able to stop it. I think it's going to creep up on them before they can reverse their tightening. That's what shows people, no, these guys do not have control of the economy. They're not able to stop this crash, and then they lose credibility.
I want to come back to this crash and your timing for this crash. You're gonna tell us exactly when you think this is gonna bottom. But first, I want to talk to you or talk to the audience about your views on our demographic trends. Now, remember that Harry wasn't always bearish. In fact, you were very, very bullish on our economy and our growth prospects. I'm talking about the U.S. in the 80s, and then something shifted, and then you changed your outlook. What shifted, Harry?
Okay, it's just demographics. I was studying demographics for my new venture clients in the early 80s. I was managing and turning around small businesses, new ventures and new industries. So I was seeing the new economy emerging in the early stages. And I was seeing, most importantly, these people were not selling goods to aging Bob Hope generation people. They were selling back then to young baby boomers. So that's when I started studying the baby boom, how big a generation it is, when do they spend money, how they can impact the economy. And of course, the first indicator I came out with in 1988 was called the spending wave. And here's how simple it was, David. A 46-year lag on the birth index, which I adjust for immigrants, and I can do that accurately. I've got accurate statistics on the age of immigrants and how many have come in and how many are projected to. And it said greatest boom in history until 2007. And what happened after 2007? We hit 2008, the deepest downturn since the Great Depression, since 1930. And central banks panicked and have been printing money ever since to offset this great downturn. They don't understand what's happening. I predicted this would happen decades. All the way in the 80s, I wasn't just predicting the boom. I was saying 2008 through 2022-23 would be a weak period in between generational spending cycles, and particularly weak because the baby boom was such a large generation to peak and crash. And that's why these guys, they thought they were just going to print some money in 2009 and be done in a year. They've been printing ever since. Unprecedented. I think it's up to $9 trillion now. They've had to print unprecedented amount of money because the downward demographic forces are that strong, and they actually do turn up around 2024-25, but they've kind of pushed this downturn out longer by by fighting it and not letting the markets do what they do best, clear out bad debts, clear out excessive valuations, so we can move on and have a healthy bull market again, which we always do when the next generation starts spending. So the next generation is going to start spending in the next year or two, but we have not cleaned up the massive debts and overvaluations of finance, the biggest financial asset bubble in everything. We've never had a financial asset bubble in everything like this. This bubble has not been allowed to burst and clear out its excesses, which we need to do. And I think we're into that process now. That they I mean, now they're having to tighten strong. I mean, they're up to 475 basis points and probably going to be at 500 in the next meeting before they stop. That's more than they've pushed up interest rates and tightened ever since the early 80s, this entire boom and bust. So this is serious tightening. Why? They had to tighten because they overstimulated in COVID. That was their biggest mistake. Now they're tightening and they're thinking, well, the economy underneath can handle it. No, the economy underneath has been weak since 2008. And does not get strong until a few years from now. So I think that's how this correction, what looks like a correction now, keeps going down, builds on itself, and turns into a crash more like 1929 to 32, down 86% on the S&P 500. That's my best forecast at this time. And we've already seen the S&P down 28%, much more than a normal correction, and the NASDAQ down 38%. And I studied every major bubble burst in all of history for hundreds of years and found that a bubble does not end until you see a first crash of 28 to 50%. So that's what that crash last year was. Now we're moving in the next wave down. I call it, so you get a first wave down, a second wave bounce, which we've seen. We're already into the third wave, just starting. The third wave usually is the strongest and hardest wave. And I think that's going to happen. Most of that's going to happen between now and the end of the year. And the biggest part of that, I call it the third wave of the third wave. So the most powerful part of the larger third wave that we're already in is going to hit between now and about mid-June. So this is the time to be cautious on stocks. If you listen to me now, then you'll probably listen to me more down the road. But just listen to me now. This is a really good time to lighten up or get out of stocks and see if this crash happens. Because if it does, we could be down 50% on the NASDAQ from the top, literally by mid-June or so. And that's going to be very painful for investors.
You mentioned that between 2008 and 2020 or 2022, back then you forecasted that this period would be a period of very low spending. Okay, fine, but we also had a period of extraordinary growth for the S&P 500 or any stock market index. What was that caused by? It wasn't caused by spending then, right? It was something else?
Well, it was caused by massive money printing, which did increase consumer spending. Consumer spending would have been much weaker. So they were literally pouring money into the economy to help offset the natural slowing. It's not that individual families are spending less. It's just you have less people moving into their peak spending, which again, I was the first to identify decades ago. 46 is the magic number. Now it's about 47 for the millennial. 46 is when the baby boomers, on average, spent the most money. So this whole boom was just increasing numbers of baby boomers moving to that peak spending. And ever since 2008, nothing wrong with the economy. Nobody did anything wrong. We have less such peak spenders, and that causes a natural slowing in what governments have done, because they only thought it was going to last a year or two in 2009. They thought 1 year of stimulus and we'd be out of that recession. They've had to continually stimulate the economy because it's a long-term, predictable, solid demographic slowing that you cannot cure except by printing money. And what the problem with printing money is it creates financial asset bubbles, which then will burst badly. No financial asset bubble ever of this size, and this is greater than the Roaring '20s, greater than the bubble, the tech bubble in the 99, 2000. No bubble has not burst and burst 80 to 90%, and that's what I'm saying can happen. And anybody that looks at this bubble and sees anything else is bubble blind. It just doesn't understand history, because this should be the most obvious thing on earth. We see a bubble now bigger and higher than the 95 to 2000 bubble, and people somehow think we'll come out of this with a soft landing. Last time, 2008, was not a soft landing. It was the deepest recession, deeper than 80 to 82, the closest thing to 30 to 32, but nothing will ever probably hit that again. But this is going to be stronger than that because we didn't finish the downturn in 2008. That downturn should have lasted like 30 to 32, well into 2010, and we should have had much, 15, 16% unemployment instead of 10 to 11, on and on and on. It didn't. So now we're going to see that in the second crash. In the Great Depression, the first crash was the big one. Then we had a second depression from 37 to 38 at the end. This time we get the big crash at the end here in the early 2020s because we didn't let the first crash do what the economy would have loved to do, just clear out a lot of bad debt and zombie companies, which, David, as you know, I mean, both of those are at record levels. I mean, I can't even compare this debt bubble and the number of zombie companies, which they didn't even use to measure, companies that can't pay their debt service, but can still barely be alive. We've never seen levels like this, which is a sign that the economy needs to take a break and flush out all these zombie companies and excessive debt that is unproductive now. Most debt now that was raised is not productive. The economy loves to flush that out to make us healthy again. Central bankers don't like recessions because they think they're the enemy and they don't understand that it's exactly recessions that make the economy so damn efficient. Recessions are the cleaning agent, the rebalancing agent every time we have a boom and things get a little overdone and sloppy and excessive and inefficient. I mean, the longer the economy booms, the more everybody lets their guard down. So recessions are as necessary as booms, and they don't last as long. They only last, about half as long as upturns typically, or less. So recessions are a good thing. And the way not to have a deep recession is don't have a crazy bubbly boom like we've gotten from overstimulus since 2009. This boom has all been stimulus. No demographics driving it. The boom from 1983 to 2007 was driven by the strongest demographic trends and technology trends in history. Okay? Even stronger than the 50s and 60s and the roaring 20s and early 1900s. So that was real. Everything since 2008 has been fake. And now we need to wash that out so we can see the next real trend, which is a shorter trend, but it's the millennial boom from 2020, late 2024 into late 2037. That will be their boom, and that boom will be compromised and not fully happen if we don't wash out the excesses from this baby boom. We had the boom and never let the bust do what the economy does so well, clean out all the excesses.
So the millennial generation is going to pick us up in 2024. I want to come back to that very important point. But let's talk about valuations and bubbles. So when we think about bubbles, we think about highly overvalued markets. The S&P 500 P ratio has come down like most markets. Do you think we're still in a highly overvalued territory then?
Yes. I mean, because this is a second bubble. You don't usually see two bubbles in a row, okay? The first bubble, it was not 2007. The 2007 bull market was not as bubbly. It was 95 to 2000 when the tech stocks were leading, and you had the big bubble there in the NASDAQ. And that's what's happened again. This time, it's not just the NASDAQ, it's a whole nother sector, which is not in the NASDAQ, even though it's leading edge, and that's the whole crypto. So the crypto stocks have been the biggest feature. They're the leading edge of this boom. It was not just the technology stocks, it was the .com stocks. It was the Amazon-like .com retailers that were emerging in the mainstream rapidly in the late 90s, driving that first bubble. So what this really is it's the second tech bubble. And again, you'll never see two technology-driven bubbles in a row in history. You saw 37 kind of follow 29, but that was less than a decade later and not the same level of bubble. So since we didn't have this washout and didn't clear out the excesses, all this stimulus did was to create a second artificial bubble on top of the natural one that first hit in 2000 and crashed. And you got to remember, the NASDAQ in 2002 crash with only a mild recession was down 78%. That was the biggest crash the NASDAQ's ever had in its history. And this one, I'm just saying, will be a little larger, about 92%, because that one was not allowed to go all the way. So this is what happens. Bubbles always have the biggest crashes because they have the biggest blow-offs. They're the strongest stock booms on bull markets. And so they crash hard as well. So anybody that looks at a bubble of this size, and I dare anybody, look at the stock market from 95 to 2000, look at it from 2019, 22 to 29, that bubble, look at any other bubble in history, and look at this recent bubble, okay, since 2009, the longest and biggest bubble, and tell me this isn't a bubble? You're crazy if you say that. Nobody wants to see it. And all the experts ignore it. Well, it's okay, and the Fed has it under control, and the Fed won't let this a downturn get too hard. It's already failing. I think what's going to happen, and the best thing that can happen from my view, is that this third wave of the third wave, which is naturally the most powerful you're going to see, okay, in the whole sequence down over 5 waves over 2.5 years, like 73 to 74 or 29 to 32, is going to happen fast and hard, and that's what's going to lose. People are going to lose faith in the central banks being able to contain this thing, and then they just get bearish, and then it's hard to stop the markets from continuing to fall. So I think this is a critical junction. The markets want to get back in control here. The markets don't agree with the Fed. The markets would rather flush out these excesses than keep a limping economy going on forever. But the central banks and politicians want to get reelected now, and they don't want the economy to go down on their watch. So they're basically wimps in this case. The market as soon as the central banks kind of get run over or lose control there, the markets are going to go down and usher in a deep debt detox. It's a debt detox is the best thing to call it. We basically need to wash out a lot of bad debts and zombie companies which shouldn't exist. The free market capitalism is equally boom and bust. The bust are necessary, as I said earlier, to clean out the excesses you're going to get in every boom. You can't have a boom without a bust to clean up and take out the garbage and get ready for the next great boom. And if you don't, and this would be the first time in history if you don't have that downturn in between, like we saw in the 70s and we saw in the 30s, then the next boom will be compromised. There will not be the productivity and the growth there full out because we're still carrying unproductive debts, lugging them into the future.
What's your view on cryptocurrencies? In your recent newsletter, you pointed out the fact that Bitcoin still overwhelmingly dominates the overall crypto market cap. So I guess I'll ask you what your view on Bitcoin is, given that you think there's going to be a crash in the NASDAQ and given that historically they've been correlated.
Yes. Okay, real quick. So I'm predicting the S&P will go down 86%, the NASDAQ 92%, and guess what? The crypto sector, Bitcoin being, because there isn't a good enough index, will go down more like 95, 96%. So they are lead bubble. And so that means Bitcoin goes, and nobody's going to believe this in that industry. And I'm down here in Puerto Rico surrounded by crypto people. They've all moved here for the tax purposes because they're in big capital gains industry. That Bitcoin will fall from 69,000 to about 3,000 to 4,000, David. And people say, then people will say, oh, well, that was just total BS. Oh, it was just a big hoax. No, it's exactly what Amazon and the .coms did. That will even prove to me more. This bubble, the size of this crypto bubble says to me, this is not a joke. This is the next big thing happening. It monitors and echoes the .com bubble perfectly. And the crash should be equally bad, 95 to 96%, which is what Amazon and the .coms went down, and then have a great boom for decades to follow. So this is just the baby bubble in a longer boom that will not peak until the 2030s when the millennials peak in their spending cycle is when you'll see crypto and all these things like Bitcoin and blockchain. And it's not Bitcoin. Bitcoin is just kind of the lead dog here. Blockchain is a way of reconstructing all financial services. It is basically a revolution, particularly in financial services. And why is financial services so important? For the first time in history, we have the point where everyday people have substantial wealth. have hundreds of thousands of dollars going in retirement. They didn't have that in the roaring 20s or in the 50s and 60s. So this is a wealth revolution. This is a revolution in financial services being ushered in by blockchain technology. And I see Bitcoin. Bitcoin is not that useful. I see Bitcoin being the number one, 43% of the whole index today, okay, of the $9 trillion in value there, 43% of it's Bitcoin. I see Bitcoin becoming the standard for a digital global economy, like gold in the past was this monetary standard in a more material, less information intensive economy in the past. I see gold cannot be that standard. It's not the new economy. Bitcoin is the new economy and is big enough to be that standard. And that's why I see Bitcoin will survive, because otherwise Ethereum does a lot more useful stuff than Bitcoin, for example.
How do you see the economy unfolding over the course of the year? Unemployment data came out this morning on Friday, and surprisingly to some people, it came down, not up. 3.5% was the latest reading. It was 3.6%. People are saying that this is, and actually the labor force participation rate has also been inching upwards. People are saying that the labor market is improving, even though every day we're reading headlines that XYZ company is laying off workers, McDonald's being the most recent one. So what do you think? How would you evaluate the strength of the economy in 2023?
Well, see, one of the things people miss, David, when we had the last crash, okay, basically a lot of people exited, okay, and just didn't come back. People got to remember, the baby boomers are almost fully in retirement. They're in their retirement stage. They peaked way back, in 2007. So they've been moving increasingly into retirement and will continue into 2019. Into 2029 to do that before they're fully retired. But they are retiring. They are leaving the workforce and not coming back. So that's what people are missing. Oh, unemployment is remaining pretty low. It's because a lot of people have left, okay? They're not measuring those people. What happened to those people? And of course, they're going to be spending less money in retirement. People peak at 46, plateau into their mid to late 50s, and then spend less in the retirement and death. So the largest generation in history is just going to be spending less, and that is going to be a drag on the economy. And that is what would have, without all this stimulus, caused much higher unemployment and much weaker stock markets from 2008 through 2023 here. Now I say, because they pushed this off, we don't probably bottom in this downturn in stocks until mid 2024, maybe late 2024. So a couple of years later than the natural time, which would have been late 2022 in these cycles. And we have yet to see the deepest downturn yet. This downturn should be 50% stronger than the 2008 to 9 downturn. Okay, and the stock market should be down 86% S&P instead of 57%. Everything I see, unemployment will be 16% instead of 10. Stocks will be down 86 S&P instead of 57. Everything's going to be about 50. Best way to look at this next downturn, if I'm right, it'll be 50% worse than 2008 to 9. And that is the worst downturn any of us have seen in our lifetime. The early 80s and the 73 to 75 downturn were not as strong as unemployment or stock crashes as that one. This is going to be stronger than that if I'm right. So if I'm right, you better get out of the way. And if I'm wrong, you might miss, a couple months of this thing before you realize I'm wrong. But I'm telling you, if I'm right, it's likely to follow through. We're well into this third wave down, and that's the damaging one. That's the dangerous one. I think you're going to see that hit in the next couple of months. So just give me 2 months of you being conservative and see if I'm right. Then you can listen to me and continue to follow me. But just be careful the next 2 months is my advice today.
We'll follow up with you in 2 to 3 months. But Harry, I want to talk about 2024 and what's beyond. So what turned you bullish? Now you're saying that the millennial generation coming in spending money could potentially make you bullish. Let's talk about the demographics. Interesting trends that the millennials have. slightly more educated than the boomer generation on a per capita basis. They still have less wealth than the boomer generation, although I was reading millennial wealth has doubled since the pandemic. Household formation is going down. Younger people are having families later in their lives than previous generations. And we're seeing less adoption or less purchases of real estate. More millennials are at their current age are renting as opposed to prior generations who have already bought homes. So how do all these trends play out, and how do you think millennial spending will differ or be similar to, let's say, boomer spending?
Okay. This is why the economy knows better than dumbass economists. Okay. I hate to say that, but dumbass economists. Okay. The economy, why can't this generation afford real estate? Because we had the greatest real estate bubble in history, a second one, which you never see, as I say, two bubbles in a row. We had a first real estate bubble in 2000 and then a second one now. Real estate is the most unaffordable it's ever been. And we didn't have a real estate unaffordability problem even in the roaring 20s bubble, okay? It was a stock bubble because real estate was too hard to finance back then. Back then, you know what a mortgage was? 50% down and 5-year termination, okay? 5-year maturity, okay? So people couldn't speculate and couldn't get loans so easy back then. So we've had very easy mortgages, a second real estate bubble. And that, of course, that's why this poor generation can't afford to buy a new house or the same house a baby boomer could have when they were in their late 20s. Typically, your first home purchase is peaks at 31, and then your second home, your trade-up home, your largest home peaks at 42. Well, for this generation, they're not getting their first home until 34 to 35, and who knows when they're going to get their trade-up home. And that's why the economy will solve this overnight, David. All we need is a big recession, which will look at more like a depression, and real estate will come down. And this is my forecast as well. Stocks 86%. Real estate will come down for the average house 50%. And people say, oh, that can't happen. We just saw 34% in the last downturn, which the central banks purposely cut off before it did its work. Okay, that would have so 50% is not a stretch. And this is what's going to hurt most people. The stock market goes down, comes back faster. Real estate didn't bottom in the last downturn, David, the 2008 crisis, until mid-2012, 6 years later. Stocks bottomed a couple of years later, okay? So real estate is what's going to hit people the hardest. And we probably will not, and I've been predicting this for a long time, not just reading, we will not see the peak real estate prices we've seen here for the rest of our lifetimes, if ever. Not even in the millennial boom, because the millennial boom will not be in a bubble era like the roaring 20s or like the 90s and 2000s here. So they'll drive real estate back up, but it will not get to bubble levels because it will not be a bubble boom. What people have to realize, and my recent books have been bubble this, roaring 2000 stuff. We won't see this again. We will not see a bubble economy for our kids. Will probably not even see a bubble economy decades and decades from now. They are rare. The last bubble economy was the early 1900s into 1929. It happens once in a lifetime at most, every 80 to, and
this is
the
it.
Bubble cycle is a 90-year cycle.
And this is the bubble of our.
The bubble before that was 1837 peak. 90 years before 29.
And this is the bubble of our lifetime right now.
This is the bubble of our lifetime, and bigger than either the 1837 peak or the 29 peak.
Are you not concerned?
And it is even called now by dumbass economists the bubble of everything, the everything bubble. We did not see everything bubble in the previous bubbles.
Well, Harry, are you not concerned about generational wealth being wiped out by this bubble burst? I mean, if
Absolutely.
Housing goes down 50%, well, how are millennials going to have money to spend in this next coming boom then if everything is going to be down 90%?
I'm not worried about the millennials because they're not even in their big save. The saving cycle is from the kind of early 50s into retirement, age 63, okay? So that's when people save. They're not even there yet. Yeah, they're saving a little bit, but this is going to clear them so they can actually the millennials will actually be able to invest in financial assets from real estate to stocks to bonds at fair valuations again, so they can actually appreciate in the next boom, their boom, okay? The baby boomers are seeing a totally artificial bubble here that was way past their natural peak in 2007. We should have been in a downturn since then. And so this is an artifice, but this is going to kill the baby boomers because they're the ones in retirement now or about to enter retirement, the last third of them, and they are not going to have that as much savings as they thought. And they're going to feel like, oh my gosh, I got to keep working. I can't even afford to retire. This is going to be the biggest crisis in the baby boomers' life. The biggest crisis of the Bob Hope generation was the Great Depression. This is going to be the big crisis. The final kind of depression into this is going to hit the baby boomers the hardest because they're going to need that net worth that's going to disappear at the speed of light. And I mean disappear, not come back.
Final two-part question for you, Harry, is when are we going to see you become bullish again? What factors would drive this newfound bullishness in you? And given your outlook on the economy and stock markets and cryptos now, what are your investment plays for us?
Okay, first of all, the natural cycles will turn up around late 2024. So 2025 on would be bullish without stimulus, is what I'm saying, okay? That's when we will see the millennials actually, for good, solid reasons, driving up the economy again, okay? So now, that could start a little later by pushing this out. This crisis, this crash now, that only started at the beginning of 2022 with the peak in the S&P 500 is likely to last well into mid to late 2024 when it normally in the cycles would have been over by late 2020, early 2023. So if we have this crash, if this crash is allowed to continue and they don't blow their way out of this one, and you got to remember, they've been tightening now for a year, okay? And they're about to stop that, but not turn around and loosen again. So they're still in a tightening mode overall. Okay, so if the economy keeps going down, then we could be over this as early as the summer of 2024 for the stock market, and I would say at the latest late 2024. It depends on how it proceeds from here. But if this crash, if this third wave of the third wave I'm talking about continues down, and if it does, you should see that by about mid-June, give or take, okay? So it's not going to take long to see us down. Oh my gosh, now we're not talking 30-some%, we're talking 50-some% for the NASDAQ, okay? And close to that for the S&P. That's when people understand this is not a correction. This is not something that can be fixed by money printing. We are in a deep downturn. And then they get scared. And then it's hard to get them spending money again because they're scared, and they should be scared.
Fair enough. Well, thank you for your thoughts. I mean, excellent analysis as always, Harry. I appreciate your candor. And where can people find out more about your work?
Okay, harrydent.com. Just go to that simple website. You get on our free newsletter. Now, right now, I would tell people it might be a good time to get on our paid newsletter, but you can get on our free newsletter immediately. You'll get an article from me and my partner, a one-page article and chart every week. And we do that until people get enough confidence in us to get on our paid newsletter and let them, but they can sit on that free newsletter as long as you want. So you can't go wrong with that, especially at a time like this. You got to listen to contrarians at a time like this. You can't listen to the normal economists. They're always going to say it's okay and the central banks have this under control. I think that's going to be disproven very quickly, but I've been saying this from the beginning. You can't stop. You can't put off a crash like this forever. The economy is going to win in the end, and it should.
Well, we appreciate all viewpoints, including the contrarian. So thank you for lending us your time and your voice today. Thank you, Harry, for coming on the show. Appreciate it.
Okay. Thank you, David.
And thank you for watching my show, The David Lim Report. I'll put the links down to Harry's newsletter in the links below. Thank you, and don't forget to subscribe.